Hey guys, my name is Max Convexity. Thanks for tuning into my station. We're going to talk about the ETF BLOX today, but first I'd like to mention that this video is sponsored by YouTubers.com. Now this is a great company, and it's actually one of my subscribers named Adnan contacted me, and he is actually one of the people involved with this company, and they've agreed to provide me a thumbnail. You guys will probably be happy about that. You've had to stare at my ugly thumbnails for the past year and a half. So I'm really excited, but give these guys a shout. I'll put Adnan's email right here. Give these guys a shout if you need any video editing, if you need anything at all for your YouTube channel. They look kind of like a turnkey solution. Thank you very much, Adnan. I really appreciate it. All right, on to today's business. Today's video is about BLOX, B-L-O-X. Now, BLOX just paid a dividend, and I believe it was their third one. They've been around 1 month and 1 day. I love to see this in a high yield fund. So BLOX is the new ticker from X funds. And I had a video about this when it first came out. Like I say, it's been around about 1 month and a day. The latest dividend was 15.33 cents. Now at this rate, it's going to pay, because it's a weekly payer, that comes out to about $8, which isn't too bad for something that just cost you $20 originally. Here's the other good news about BLOX. BLOX opened at, well, $19.17, but right now it's trading at $23. So the total return is up as well as the NAV return. You can see right here, BLOX is just absolutely spanking the SPY. BLOX has a total return for just over a month of 22.65%. You annualize that, comes out to 285%. The SPY's doing really well too in the last month. The SPY's up 4.75%. If you look here and you compare BLOX to IBIT, which is the uber successful brand new Bitcoin-based ETF with, I think, 75 billion under management last time I checked. BLOX is beating IBIT by a pretty good margin also. They've almost got IBIT's total return doubled. BLOX, like we said, was up 22.65%. IBIT over the same time frame was up 14%. So these guys at X Funds are using an option strategy invented and even trademarked by Jay Pestrichelli, head trader of Tidal Financial. The trade is called the lightning spread. If you'd like to learn more about this strategy, we're going to go over it here in just a second. We're also going to go over some of the trades that are in the portfolio as of today. I downloaded the trades, and we're going to look at these. And I'm also want to talk to you a little bit about how the lightning spread works and what is it going to do for us and what is it going to not do for us. Additionally, I've asked David Nicholas, the principal at X Funds, to be on the channel, and I hope to get him on soon. He had an excellent interview yesterday or the day before with Income Architect, my friend Brad. I've never met him, but I feel like he's a friend. And then also there was a good interview with my friend Jonathan Kwan. All right, so let's look at this. So I downloaded the trades and put them on a spreadsheet. So at the top, we have all the stock positions. So they have Coinbase, they have Robinhood, they have Galaxy Digital, Riot Blockchains, Mara, Hut 8, MicroStrategies. Of course, you can't be a crypto fund without having MicroStrategies, right? Have NVIDIA. I mean, you couldn't run a DeFi business without really fast processing, and that's what NVIDIA gives. Not to mention Taiwan Semi, Block, Circle, HODL, which is the VanEck Bitcoin ETF, and they have some other things as well, a little cash and another Bitcoin ETF. The part that I'm more interested in is how are they paying a yield with all these stocks? These stocks don't pay a huge dividend. I don't think any of them probably pay a dividend at all, most likely. Maybe, but these stocks are more growth stocks. Well, what they've done to try to extract a synthetic dividend from it is they're selling options. So this is something we're familiar with, right? We're pretty familiar now with covered calls. You can own stock and you can sell an out of the money call option. You can get a little bit of upside and you can get a little bit of yield. There's a lot of ETFs that do that. and they'll pay you the yield every month or every week. It's the greatest thing ever, right? Okay, this is just a twist on the same theme. These guys are selling options also using this lightning spread, but they're doing it. It's a more esoteric type strategy. So let's kind of get into the middle of it. I went here and I just pulled out 4 of the option positions and color coded them. So FBTC. So this right here is Fidelity Wise Origin Bitcoin Fund. On FBTC, these guys own shares. They own 16,506 shares. At the same time, though, they sold a call, or I'm sorry, they bought a call. They bought 165 110 strike calls to go out to next Friday. Then at the same time, they sold a call at the 105 level. They sold it 165 times. So they're essentially trading a call spread. Now, this is a little bit different than YieldMax does it. Let's go look at this trade. FBTC. Okay, so to review, they have the shares, and we have it right here, long 16,500 shares. I didn't get the 506, but I guess we could just put that in for the sake of accuracy, right? All right. And then they bought the 110 and they sold the 105 165 times. Okay, so this gives them a profit loss profile that actually does look just like the YieldMax covered call spread strategy. And go figure, because what is this? This is a covered call spread. A covered call spread is where you own stock and you do a covered call. But the spread part of it is you sell a call option to do a covered call. Well, at the same time you're selling that call option, you go a few more strikes further out and you buy a call option. What this does is it uncaps your upside. As we all know, covered calls are capped to a certain point. When you put on this structure, you can still get partially uncapped upside. You're capped to a point. So if between now and expiration, this ETF is up, it goes from where it is now to up 6%. That they are capped out. They are capped out, but should it go up, say 12%, and then they have, let's call that half upside. They didn't get any upside on the first 6%, but then they got full upside on the second 6%. We'll call that half upside, which is about what it comes to. So this is a nice strategy. And this isn't a bad strategy. You could do this yourself. Look at this. You sell this thing for $200 and you buy this thing for $60, right? And you could do this if you had 100 shares of FBTC. You make $140 between now and the 25th, or you get $140 into your account. Let's look at the next trade on the list. We also have CRCL. Okay, so this is a hot new stock that everyone's talking about. Now, they did put spreads on this one. This one's a little bit more complex, but let's get into the middle of this one. All right, let's look at a few more trades here. Let's see what they did in CRCL. All right, CRCL, they have stock. Let's see how many shares of stock they have. Right there, they have 1,210 shares of stock. Well, they sold, this time they're selling puts. So this is a lightning spread. A lightning spread is stock plus a put spread. I'm going to talk more about that, but what you're going to do on a lightning spread is you're going to sell the strikes that are closer to the money and buy the strikes that are further out of the money, otherwise known as a bull put spread. Anyway, let's just look at their positions. So they own the 232 strike. They're going out to the 25th also, so the next Friday. They own that 4 times, so that's worth 400 shares. So somewhere else, there's going to be a tranche with the difference, which will be 8. There it is. They also own the 190 8 times. Okay, so they own the 190 and the 232. And then they sold, the ones they sell are going to be closer to the money. In other words, a higher strike price. And sure enough, they sold the 240. And then they also sold the 200. They do the whole trade for a credit. It's a great trade. Let's see what else we have in here. It's a real light shading job, but you can kind of barely see the Coinbase is shaded there. So I want to really drill down on this Coinbase trade. On Coinbase, they own 1,333 shares. Okay, so I bet they have 13 options somewhere or 13 spreads. So let's go see. So the first leg here, they have 9. So you know the next leg is going to be 4. I can tell you that right now. But so, and these are also puts. So what they're going to do is they're going to buy the puts that are further out of the money and sell puts that are closer to the money, do the whole thing for a credit. That's a lightning spread. So they own the 387.50, and then they also own the 395. Now I've gone ahead and loaded this one into option strat. See that 387.50? They own that 4 times, and they own the 395. Now they aren't betting that the market will go down, but they're using those to cap the total downside exposure, the downside loss they could have. A naked put can expose you to a bigger downside loss. Well, at the same time, they have written the same amount of options. They wrote 9 405s. So they wrote 9 405s for $11, and they hedged that with the 390 with the 9 395s. They got 11, and they had to pay 7. The difference is the yield, or the difference goes to pay the yield. And they did the same thing on the 397 50s. They sold this one for about 8.5, or it was around 8.5 at the close. Let's just say they, and then they bought this one. This was around $5 at the close. So this one's trading like at a $3 credit. You could do this one and make $2.50 or $3 worth of yield. All right. So what does this do for you? What this does for you, the reason Jay calls it a lightning spread is because of the lightning bolt looking formation in the middle. Let me try to exaggerate it a little bit more. You can see right here that you have a steeper slope, and the steeper slope happens between the strikes. Between 387.50 and between 405, you're actually double long. You have double exposure, both to wins and to losses. You guys probably saw my video about the new fund LevMax. LevMax does something similar, but LevMax is getting 3x exposure. But on this one, you have 2x exposure between the strikes. So that the good news is if the market goes up, you make a little extra. But the bad news is if the market goes down, you're going to lose a little extra. But I'm trying to illustrate that. So what I've done is I put in the same trade. Right here is if you just had stock. So this is a good way to compare it. The color line is how much stock would have returned on this lightning spread strategy on Coinbase, okay? So you can see in the case of these options, if Coinbase is anywhere between down 2.3% and up to infinity, they actually have extra return because the white line is the lightning spread return. The white line is on top of the green line. So that's extra return, extra alpha, extra total return for the fund. So in theory, if you did lightning spreads and your stock only went up, you would add money to your total return without ever getting penalized for selling the options. The penalty comes if the market drops for this spread. So if the market drops more than 2.5% or something in this case, you suffer a bigger loss with the lightning spread than you do with just owning stock. The thing to understand about the lightning spread will subtract from total returns in a down market, but add to total returns in an up market just because of the way it is structured. I've taken the liberty of comparing the lightning spread with another strategy, a covered call or a short put strategy, one that's totally capped. Okay, now these types of strategies are very common in covered call funds. When you have this type of strategy, the white line is the strategy. So you actually do better in the down market, but you do worse in an up market. You do all right if it's up, but not too far. You actually do a little bit better in a mildly up market. But in a runaway up market, you leave some upside on the table. This is more typical of covered call funds. In fact, this is the way 90% of them look, and this is the returns you're dealing with. The lightning spread gives you a whole different dynamic in the sense that it adds return on the upside, no matter how far up it goes. And you don't even really have to incur a cost on the lightning spread until you get a big down move. So it's pretty much the opposite of what's out there already. So I think that's exciting. And if we want to look at it, let's look at BLOX versus LFGY. Now, LFGY is a similar type fund from YieldMax that I own, and I love it. Or I used to love it before I pulled up this chart. BLOX is absolutely dogging it. Now, but to be fair, we've been in a runaway bullish market, right? And BLOX is bloxing. It is doing its thing because it's adding alpha on the upside. LFGY, like I say, is more typical, and it can get some extra upside too. I'm not dogging on LFGY, but the more typical strategies, the profit and loss profile and the dynamics of how they work are more like this. You know, you actually do better if it goes fine, down, or up a little bit, but you do worse when it goes up a lot. It's a totally different dynamic. We haven't seen this out before. There's another fund coming out from Defiance, I believe, that is in the prospectus, said they're going to use lightning spreads, but it hasn't come out yet. So this should really be interesting. If you could predict the future and you knew the market was going to go up, you'd be better off with the lightning spread approach. If you knew the market was going to go down, you'd be better off with the more standard approach, either where you're just selling a put or doing a covered call. They're the same thing. Cash secured put and a covered call, for all intents and purposes, are the same thing, and they have the same risk. So let's look over here. All right, I'm using NVIDIA just for demonstration purposes only. So let's look at NVIDIA for the past year with the lightning spread, and then we'll also look at it with the more typical strategy. Okay, so the way you would set up a lightning spread is you would have stock, 100 shares, and for each 100 shares you own, you would sell one spread. The spread is you sell the 40 delta. Think of a 40 delta as one or two strikes out of the money. Then you would buy the 30 delta. The 30 delta is further out of the money because it's a lower number. The numbers get lower as you go further out of the money. So that one might be 4 or 5 strikes out of the money. All right, so you could do this every day. Well, not every day. We're going to do it once a week, and we're going to do it once a week and just let it expire. And let's see how NVIDIA would have done for the past year with the lightning spread. Okay, well, that's pretty good. If you would have just bought and held NVIDIA, you would have been up $5,800 if you would have invested $16,000. Now, they choose the $16,000 starting capital because that's how much it costs to run the option strategy. That's the minimum you have to have in your account to run the lightning spread. Well, in any event, the lightning spread was actually up about $1,000 more, which is on $5,000 or $6,000. That's about a 15% difference. That's pretty impressive. The other thing that's impressive, and this is just for the past year, but the max drawdown was only 15%. Whereas if you would have put the same amount of money in NVIDIA, the drawdown was about twice that, a little bit more than twice that. Now let's put in where we just sell a put. This is the second strategy I was showing you guys, and you could also do a covered call. We'll just do a covered call to make more sense to you guys. We'll sell an out of the money covered call, 40 delta, 5 days till expiration. Let's see how that does. All right, the covered call strategy did not do quite as well, and that really doesn't surprise us because it has totally capped upside. Now, the covered call strategy still protected capital very well, though. Remember, actually, the covered call and short put strategy, that's their thing, is they do protect capital better because in down moves, you get a little buffer there that you don't get in the lightning spread. So once again, this one was down 13%, and buy and hold or I'm sorry, the max drawdown was 13%. Buy and hold's max drawdown was more than twice that. So that's really good. Total return is 23%. It's not quite as good as buy and hold's total return of 35%, but it isn't bad. And if you look at the MAR ratio, the covered call strategy had better risk-adjusted return. So now let's look at the covered call spread strategy, which is something that YieldMax does also. So to set that one up, you're going to buy a 45 delta, and you are going to sell a 35. Or I'm sorry, you're going to sell the 45 delta. You're going to scoot the strike a little bit closer, but then you're going to buy something behind it to uncap your upside. So we're selling the 45 and buying the 35. Now let's see how this does. All right, so this one did not do quite as well as the lightning spread, but it did pretty well. It did pretty well. This one comes in second place. Now, it did not protect the covered call spread, did not protect capital as well as either of the other two strategies, but you still got less than half the downside, which is pretty good. Now, I've always said this, that could prevent a margin call. If you just have the stock on margin and you're down 36%, maybe that's enough to put you over the limit for a margin call. But if you're only down 15%, maybe no margin call. So the downside buffer is a real thing, and it's one of the most misunderstood elements about these high yield funds. People think they're risky, and they are, but not so much on the downside, more on the upside. Total return, both the covered call spread and the lightning spread did beat buy and hold, which is really good. The fully capped strategy, just the old fashioned covered call or short put, did not beat. So I think this is obviously I think it's a legit strategy. I think it's a very legit strategy. Let's test it on one more crypto type stock. Let's test it on MicroStrategies. Okay, so let's start with the lightning spread. So lightning spread, once again, to show how we do it in case you're playing along at home. Sell a 40 delta put option, then you buy a 30 delta put option. We're doing it in the 5-day time frame, plus we're going to own stock. And this is in MicroStrategies for the past year. Okay, so the problem with this one is this is the lightning spread, and this left money on the table. It was up 60%, but just buying and holding MicroStrategies was up 173%. This strategy did protect capital. You were only down 21% at the worst point instead of being down 50%. So that's good. That is really good. But unfortunately, the risk-adjusted reward is not quite as good. So on MicroStrategies, we're going to have to give the edge. My MSTR beat the lightning spread. But let's see, MSTR might beat everything because it's just a beast. So let's go in here and let's test a standard covered call or short put, whatever you want to call it. But all we do is we'll do a covered call since it's more accessible to you guys. Sell a call, and we're going to use the 40 strike. All right, and the 5 delta. Let's see how MicroStrategies does here. I bet it doesn't do as well as the last one. I bet it doesn't because it has fully capped upside. Sure enough, it did not do as well as the other one. And it also had it had less drawdown though. So that's good. But now let's look at the covered call spread where we uncap some of the upside and see how that goes. So again, if you're playing along at home, this is the way Jay does it. Instead of selling a 40 strike, he scoots the strike in closer to the money just a little bit. So we're going to scoot it into 45. And he has to scoot it in one strike closer to get the yield he wants. And then we're going to buy the 35 strike. 5-day time frame plus owning stock. Let's see how that did. It did about as well as the lightning spread. Now, it still left some money on the table. It's still underperformed. This one had the This one had the highest drawdown of the three of them, but they all protected capital better than just buying and holding. And they all gave you a yield. So what it always comes back to, that's why it's so important to ask yourself this one question. Do I need a yield? In other words, do I need an investment to send me a check every week? And what I would say for me, the answer is if I have a job, the answer is no, because I'll just use an investment. I'll just buy micro strategies. I would rather have $824,000 than $223, wouldn't you? But that doesn't mean there are covered call strategies that do outperform buy and hold. But in micro strategies, buy and hold won. And that's going to be typical of the stocks that are up the most are going to be the hardest ones to beat with the covered calls. And it's just because they're capped. Even the lightning spread and even the covered call spread, the covered call spread is physically partially capped. The lightning spread may not look like it is, I guess, and it isn't capped, but it does. But anytime you sell options, when you sell an option, it obligates you to do something. So the problem with the only problem I see with the lightning spread is it adds downside just a little bit. You get a little bit of extra downside in a bad market. Like I say, just figure out which way the market's going. Use lightning spreads in the up markets and use some other strategy in the down market and you'll be fine. Now, right now, since we don't know which way the market's going and we can't really predict it, how about you get a little bit of blocks and maybe you also have a little bit of LFGY. LFGY is from YieldMax and they do the covered call spreads. That has a little bit of a different, different methodology to it. Maybe you get another couple of funds that do another couple of income selling strategies. Be diverse in your strategies. It's not all about any one of them. But I will say this, the lightning spread and blocks looks like the best one out there right now. It's a small sample size, but I mean, let's look at blocks compared to ULTY. Everyone loves ULTY, right? All right. So, I mean, that's, let's look at blocks compared to Misty. I mean, what's not to like, right? All right, guys. Well, I appreciate it. Thank you for watching this video. And please remember to support theyoutubers.com and my friend Adnan. I appreciate it very much. You guys have a great day. And leave me a comment and tell me what you guys think about the lightning spread or about covered calls or covered call spreads. I like to talk about options. Tell me what you think. Tell me which one of these you're buying. If any of them, maybe none of them. All right, guys. Thank you very much. Have a great day.